On June 12th, the most advanced AI in the world was shut down, ordered to cut off its models from every foreign national, including allies. This isn't a coincidence. It's a pattern that reveals a trillion-dollar lie at the heart of the market. That's a massive immediate shutdown of critical technology. If you see that once, it could be a coincidence. But it's happened 3 times across Europe in a matter of days. Welcome to the Alpha Brief. I'm Reid, and if you're new here, we follow the money so you don't have to. Today, we're going to pull back the curtain on how a supposed technological revolution is actually a house of cards, built on an impossible business model and a geopolitical gamble that's about to backfire on your wallet. Now, why does any of this matter to you? Well, if you own a home, the stability of this market story impacts your mortgage rate, because the underlying belief in endless tech growth keeps the entire financial system humming. If you're carrying any credit card debt, the cost of that debt is tied to the broader economic sentiment, which right now is propped up by this AI narrative. If your 401k or any index funds are relying on the performance of these tech giants, then the story unraveling means a direct hit to your retirement savings. And if you're just trying to make ends meet, the eventual fallout from this bubble popping will ripple through the economy, affecting everything from your grocery bill to job security as corporate profits falter. To understand this better, the entire U.S. stock market, including your retirement accounts and index funds, it's all built on this idea, this story, that American companies are just going to mint trillions of dollars in profits forever. The logic is simple. The world will be forced to use America's technology, and we'll just keep innovating, keep growing. But a lot of people, and I mean people who really understand the numbers, are saying that this story is coming to an end. Why? Because of all the lies, the spending, and critically, the competition. The core of this market's current valuation, especially for tech, is riding on the back of this AI build-out. And it's not just a small thing. When you compare it to the TMT build-out of 1999 and 2000, the dot-com bubble, this AI surge is multiples bigger, even as a percentage of the entire economy. That's the scale we're talking about here. This isn't just a sector play, it's a foundational belief for the entire market. Now we've got 2, maybe 2.5 relevant tech centers in the world. There's America, there's China, and then there's Israel. These are the places where the real innovation happens. And the underlying assumption has been that America will win, will dominate. But then June 12th happened. That letter from Howard Lutnick, the U.S. Commerce Secretary, to a company in San Francisco. That company was Anthropic, the outfit behind the Claude AI models. And by the end of that day, the most advanced AI in the world was shut down, ordered to cut off its powerful AI models from every foreign national. And again, this wasn't just about China. It included allies like France, Germany, Japan, even Anthropic's own non-American employees were locked out. Think about that for a second. The U.S. government, through its Commerce Secretary, essentially pulled the plug on a critical piece of technology for its closest allies, and the world noticed. 4 days after that letter, France fired Palantir, the French Prime Minister. He didn't mince words.
French Prime Minister said, and I quote, "We can't depend on partners who are capable of turning off the tap."
France wasn't alone. Germany had already walked away from similar arrangements. Spain told its companies to stop signing deals. Britain followed suit. The message was clear. If you can turn off the tap on a whim, we can't build our future on your technology. So, what happened next? The world found out it had a choice. And this choice wasn't just about national security or sovereignty, it was about economics. Because while America is spending a mind-boggling $1 trillion a year building out AI, that's 3% of the entire US economy, by the way, China is spending a fraction of that. And they're giving their AI away, virtually for free. This isn't just a minor cost difference. It's 7 and 12 times cheaper, depending on the specific application. That's an impossible gap to bridge in a competitive market. Now, this leads us to the hidden mechanism, the real follow-the-money story behind this AI bubble. It's not just about geopolitical competition. It's about a fundamental flaw in the business model itself. The theory that these tech companies are pushing, the one that justifies their insanely high stock prices, is that AI is the next hypergrowth engine. But what if they've just run out of really good ideas? What if this is less about innovation and more about finding something, anything to keep the revenue narrative going? Listen to what Ed Zitron, a sharp observer, said in a CNBC interview.
Ed Zitron said, and I quote, "But fundamentally, large language models are not the future. The only reason big tech is investing in this is that they've run out of hypergrowth ideas. They don't have a next iPhone. They don't have a new Google search. So they've put over $1 trillion, with trillions more to come, into a kind of a dead-end industry because when that ends, they'll have to admit that they don't have anything else."
Think about that. Over $1 trillion, with trillions more planned, poured into what some experts are calling a dead-end industry because the tech giants don't have a new iPhone. They don't have a new Google search. They just don't have the next big thing. So, they're inventing a problem to sell a solution that nobody really trusts. And trust is a huge problem. Alex Karp, the CEO of Palantir, that's the company that works closely with the US government and pretty much every three-letter agency you can think of, he brings up a really critical point. Nobody really trusts AI right now.
Alex Karp said, and I'll quote, "Who owns the data? Where is it cached? Are the prompts secure? Is this being transferred to you? Are you being comp? Okay, if it was so valuable, let's say I can make you $1 billion right tomorrow. Wouldn't I say I'll make you $1 billion and I want 30%? Why are they charging for tokens if it's so valuable?"
He's asking a fundamental business question. If this AI technology is so incredibly valuable, if it can really create $1 billion for you, why are they charging per token, per word? Why aren't they saying we'll build you $1 billion business and we'll take 30% of the revenue? That's how you pay for almost everything else in business, right? You pay a lawyer to win a court case. You pay a contractor to remodel your house. The price you pay is attached to a specific result. But AI companies, they charge you for every word the AI reads, every word it writes, whether the answer was good or completely useless. Karp is not alone in this frustration. He says enterprises are livid.
Alex Karp said, and I quote, "But I'm telling you, in this country, at every single enterprise I deal with, these people are livid. They're like, I am paying for tokens that create no value. These people are stealing the weights and alpha of my business, and they're creating a wealth tax that does not help the poor. It just punishes, starts with the billionaires. Every single person at this table is going to be paying a wealth tax only to punish us."
He's calling it a wealth tax that punishes businesses, stealing their alpha, their unique competitive edge. And he's right. If these companies were truly confident that their AI created immense value, the sales pitch would be easy. Pay us nothing unless we make you money. Pay us nothing unless we build you $1 billion idea. But they can't offer that. Why? Because these models hallucinate. They confidently make things up, and nobody, not even the people who built them, can tell you when or why it happens. Nobody has figured out how to fix it completely. Even the CEOs of these companies, like Anthropic's Dhirama Day and OpenAI's Sam Altman, have both said it. Anthropic CEO Dhirama Day and Sam Altman, we can't wait to see what you build with this. Think about the implication of that statement. It means they don't know what you can build with it. They want everyone else to do their innovation for them, to spend as much as they can on tokens, and then just take whatever's left. Except as we're seeing, these companies lose too much money for that strategy to actually work. And this puts every corporation in America in a deeply awkward situation. Imagine you're the CEO. You just spent $50 million on AI this year. Your board asks, what did we get for that $50 million? What's the ROI? And you have to say, I don't know. Nobody has a number. Corporate America is paying subscription fees on a technology whose outcome they cannot measure. And it gets worse. Not only can they not measure it, but they're also risking their company secrets, their intellectual property, and potentially creating their own competitor.
Alex Karp said, and I quote, "But something has gone completely wrong. And the basic view among enterprises in this country is, I'm going to chillax and waste my time with tokens. I'm going to get no value, and they're going to get my IP."
Fear is real. When your company uses these AI models, your data flows through them. Your processes, your trade secrets, the special sauce that makes you profitable, what Karp calls the alpha. All of it is exposed. What happens when the AI company you're paying learns from your business and then just becomes your competitor? Anthropic launched a design product called Claude Design while having a relationship with Figma, a design company. Figma CEO publicly said he was shocked. Picture that. You're a business, paying your vendor millions of dollars a year to use their AI, but what you're actually doing is paying them and training your own replacement. So, what's the solution then? This is where it gets really interesting, because the most technical players, the ones who truly understand the underlying mechanics, are saying something different.
Alex Karp said, and I quote, "But what is happening among the most technical players is they're saying, I want something I own. This is my business. I want to own the GPUs. I want to own my data. I want to own the model. I want to control the alpha. Why would they get access to my data? If they're going to build my alpha, why wouldn't I control the weight?"
What that means is, instead of renting an AI from a third party, you just download one. You run it on your own computers, using your own data, where no one can see it, no one can learn from it, and most importantly, no one can shut it off. Karp points out that most businesses don't even need the latest, greatest cutting-edge AI. You don't need the smartest one in the world to process insurance claims, right? You need one that's specifically really good at insurance claims. Now hold on, Alex Karp profits from this business model he's advocating. So why is he out there saying all this? Remember France, Germany, Spain? They're canceling their contracts. Palantir has been losing those contracts across Europe all year. 2 days before that interview, Palantir announced a partnership with NVIDIA to sell open models in sovereign environments. That interview? It was basically a product launch for his new service. He's out there telling companies to download and own their own AI, because that's the new business he's selling. So that's the first problem with AI. Nobody trusts it. But there's a second problem, and it's even bigger. Even if every company in America trusted these AI companies, the money still doesn't make sense. The business model is broken in a way we've never seen from tech companies before. See, here's how software is supposed to make money. Software is the greatest business model ever invented because you spend a lot of money building the thing once, right? And then every new customer is basically free money. That's why tech stocks have done so well over the past few decades. When you buy Microsoft Excel, Microsoft doesn't spend anything extra to sell you that copy. Their costs stay the same, but their revenue goes up. And it's the gap between those two lines, costs and revenue, that is their profit. That gap is why tech companies are the most valuable companies on earth. AI broke that model, and how they broke it is, every single time you ask ChatGPT a question right now, it costs OpenAI money. It uses electricity. Chips are being worn down. So more customers does not translate to free money anymore. More customers means more cost, dollar for dollar. So AI is not a software business. It's more like a restaurant, right? Somebody has to buy the ingredients every time. Except this is a restaurant that loses money every time it serves food. And its plan to fix it is to serve more food. That math just doesn't make sense. Let me give you some context. In 2025, OpenAI burned over $20 billion in just 1 year. $20.9 billion. Henry Jick, discussing OpenAI's financials, noted.
Henry Jick said, and I quote, "Well, they be the first to be this bad other than WeWork. And even then, this is so much worse than that. OpenAI burned $20.9 billion in 2025. That's the audited financials that the FT&II reported."
Basically saying that costs increase linearly with revenues. The two lines are going up together, and the gap never really opens up. For 25 years, every investor has been trained to be patient with this. They say, well, they're losing money now, but at scale, their margins will get better, right? Amazon lost money for years. Except with AI, we just keep on waiting, and the margins are getting worse because every new model costs more to run than the last one. And the market is starting to notice it. Henry Jick also pointed out,
Henry Jick said, and I quote, "There is no proof that they can improve their margins. No amount of specialist silicon or supposed Vera Rubins will bring these costs down. And we're at a point now where OpenAI is now potentially pushing their IPO to 2027 because they couldn't get a $1 trillion valuation. It's clear that people are wising up to the problem of generative AI, which is, There's not really a business there.
This isn't just about OpenAI, by the way. This is about anyone paying to build all of this. It's a systemic issue. Now, let's talk about what this does to your personal finances. This isn't just some abstract tech problem. It's going to hit your wallet directly. For your 401k and retirement accounts, if the foundational story of endless American tech profits, driven by AI, starts to unravel, the entire US stock market, which has been inflated by this narrative, is vulnerable. Your index funds, heavily weighted in these tech giants, will see significant downward pressure. This isn't a small correction. This is a reevaluation of core market assumptions. The value you've built up over years could diminish rapidly as the market adjusts to the reality of broken business models and aggressive global competition. If you own a home, the broader economic stability, fueled by what is essentially a speculative bubble in AI, keeps interest rates in check. As this bubble deflates, the resulting economic uncertainty could lead to tighter credit conditions. Banks, facing a less robust corporate landscape, will become more cautious. This means higher mortgage rates for new borrowers and potentially higher variable rates for those with adjustable loans. It's not just about tech stocks. It's about the cost of money across the board. For your savings, you might think that higher interest rates would be good for your savings account yield, right? But if the economy falters due to a major tech correction, the focus shifts from growth to stability. Central banks might be forced to cut rates again to stimulate the economy, leading to lower yields on your savings. Alternatively, if inflation remains stubbornly high due to other factors and the Fed is still trying to fight it, your purchasing power continues to erode even if the nominal rate holds. Either way, your real returns suffer. At the grocery store, the massive spending on AI by US companies, $1 trillion a year, is a huge drain on resources. This kind of capital allocation, often inefficiently, contributes to overall economic overheating and misallocation of talent. When the bubble pops, the immediate impact could be a recession, leading to job losses and reduced consumer demand. But the longer-term consequence is that the underlying inefficiencies don't just disappear. Supply chains might become more fragile, and the cost of goods, including your groceries, could remain elevated as the economy struggles to rebalance. It's a messy unwinding that doesn't just reset to zero. For your paycheck, if corporations are spending $50 million on AI and getting no measurable return on investment, that money isn't going into wage increases or new hiring or research and development that actually creates value. When the inevitable reckoning comes and boards demand accountability for those wasted millions, companies will look for ways to cut costs. This means hiring freezes, layoffs, and a general tightening of the belt, directly impacting job security and the potential for wage growth across many sectors. The wealth tax that Alex Karp talked about, the one where companies are paying for tokens that create no value, that cost ultimately gets passed down, one way or another, to the employees and the consumers. Winners and losers in this scenario are stark. The early investors and founders who manage to cash out before the music stops, they'll be the clear winners. But the losers? It's going to be the average American investor whose retirement is tied up in these inflated valuations. It's going to be the small businesses and enterprises who were pressured into adopting expensive, unproven AI solutions, only to find they were training their own competitors or just burning cash. It's the broader economy that has to absorb the shock of a $1 trillion a year spending spree that yields no tangible, measurable return. This isn't just a tech story. It's a story about misallocated capital on a scale that will impact everything from your rent to your gas prices. Now, I don't know exactly how this plays out, and nobody does. Maybe it resolves smoothly, maybe the market just slowly corrects. That's possible. But the physical evidence, the broken business models, the geopolitical shifts, and the sheer scale of the money being burned are all pointing the other way. My read of the evidence suggests that over the next 6 to 12 months, we're going to see a significant recalibration of AI valuations, particularly for companies with token-based revenue models, as corporate America walks away from unmeasurable ROI. This will ripple through the broader tech sector, putting downward pressure on the market's overall story of endless growth. The number I'm watching closely is the quarterly reports from major tech companies, specifically looking for any shift in their AI spending and critically any attempts to actually quantify the return on investment. If that ROI remains elusive, or if spending starts to contract, we'll know the story is truly changing.